Good morning, I'm John Levy. Welcome to our continuing podcast on trends in the commercial real estate market. Last week I was on a plane, and while I was seated, a bunch of bicyclists came on, and they all had on t-shirts, and on the front of the t-shirt was a picture of a bicyclist climbing a mountain. And on the back of the t-shirt were the words, "Stop whining and pedal." I laughed when I saw it, but I think it has a lot of applicability to the commercial real estate market today. In this podcast, I'd like to offer a few thoughts on how we think the commercial real estate market looks after the collapse of Bear Stearns. Let's face it, 2008 has been off to a rugged start. Volume is frankly terrible. And compared to 2006 and even to 2005, volume is anemic by almost any standards, by new originations, by sales, by CMBS production. But if we look back a bit further, we're about at the same level for the first 4 months of '08 as we were in 2004. And it's important to remember that 2004 turned out to be a very solid year. So with that in mind, I think it depends on how we want to look at the market. Do we want to look at it as having a glass that's half full or a glass that's half empty? When does the 2007 market return? In our opinion, no time soon. In fact, I think we'll look back at 2007 as an aberration, not the norm. But it's not time to hold a funeral, but it is time to stop the bitchin' and look for what works, and in our opinion, plenty does. On the debt side, we encourage borrowers and owners to focus on interest rates, not spreads. After all, interest rates are what you pay, and even though spreads are high, interest rates are very, very moderate. Today, money costs somewhere in the 6 to 6.5% range, and by historical standards, that's just cheap. If you're worried about lacking leverage and locking in for a long term, the answer is don't. Choose a 3 to 5 year loan. That way you'll have a loan that will get you over the current credit market turmoil, and if you do choose to prepay it, the prepayment will be modest. In addition, if today's first mortgages don't work for you, there is an abundance of mezzanine debt, preferred equity, and joint ventures. And that type of extra leverage may be necessary to get the total leverage that you need. But keep in mind, today's underwriting is based on actual cash flows. The pro forma cash flows, or the make-believe cash flows that were in 2007 and even in 2006, they're gone. Looking ahead, in predicting rates, we would not encourage you to wait. What we've found historically is that although spreads do decline over time, treasuries increase faster than spreads decline. And as a result, as a borrower or as an owner, you actually pay higher rates. So if you're waiting for average rates to decline over the near to intermediate term, you're probably going to be gravely disappointed. And if treasuries decline, then we are in a real serious recession where it will be difficult to get any real estate capital, much less at attractive rates and attractive leverage levels. So what do we see for 2008? We see a need to stop the bitching. We see a need to look at the glass as half full, not half empty, and to realize that today's rates are attractive even though they don't resemble the types of leverage that we saw in 2007. We do think, however, that today's rates will be cheaper than they will be in the near to intermediate term. In our next podcast, our partner, Andy Little, will be looking back at the first 6 months of this year and giving his views on what has happened, but more importantly, looking ahead for the remainder of 2008 and showing how to make money in a challenging environment. If you have comments or questions about our podcast, we welcome them. Please email us at jlevy@jblevyco.com or call our main number, 804-644-2000. We thank you.